It is tax time, and as such, a lot of folks are gathering their personal tax information, but a lot of businesses, specifically partnerships and S-corps, at least that's what we're going to be talking about, are working on getting tax returns completed and schedules K-1 out to their partners, members, and shareholders. So what we wanted to do is talk about a number of things, 10 things, in fact,
10 things
that you need to know about. We're going to call it partnerships and S corporations, and talking a little more about what we mean by partnerships is one of the things. It just seems like this time of year, people have a lot of questions about what's on their K-1s, or if they are preparing returns for a business, how to account for things.
Yes, and I think it's a good time to note that some shareholders or members may be getting an additional tax form this year that we want to mention.
Right, but that also, one of the 10 things, and that's the last of the 10 things, and that is a blatant and brazen attempt to get everybody to stay till the end of the video. The last of the 10 things is going to be a brand new thing this year that folks do need to know about, whether they are waiting to receive a K-1 from a partnership, LLC, or S-corp, or if they are certainly managing the business and either preparing or having a third party prepare those returns. So, you ready to kick it off?
Ready.
What's thing number one?
Number one is that there is no tax for federal purposes at the entity level.
Right. And most states.
Most states. S corporations especially pay franchise tax in some states. So, but for federal purposes, all of the income is passing through to the members or shareholders. You know, that's why we call them pass-through entities.
Right. And that is an advantage in a lot of cases to using a pass-through entity, an S-corp or partnership, instead of a C-corp. Now, there are exceptions to that, just like there are certain exceptions to a partnership or an S-corp not paying income tax at the federal level. We're not going to talk about what those exceptions are, but they do exist. But generally speaking, the income from a partnership or an S corporation passes straight through to the owners. And some of this is going to be stuff that's really obvious to folks who already own an interest in an S corp or partnership, but some of it maybe not. And again, we do work with folks who every once in a while, I won't say are confused by it, but as they're looking to change things, figure out what their flexibility is, they need to run back through, okay, mechanically, exactly how does this thing work? So that's number one on our list, and we think it's an important number one. So the next thing, and I mentioned this earlier, let's talk about what a partnership means. I sometimes get questioned on this because whether I'm talking with a client, whether I'm giving a presentation or even doing a video like this, I will use the word partnership to mean a lot of different sorts of legal entities. So when we say partnership, we mean anything that for federal and most state income tax purposes is treated as a partnership. So that can be a general partnership. It can be a limited partnership. It can be a joint venture that's not really organized as an entity as such. It can also be a number of incorporated type entities in various states, and it varies by state. Things like, and these are used a lot. I've done a 4-hour presentation on this before. I won't do that today.
No.
LLCs, LLPs, PLLCs. So anything that is treated as a partnership for tax purposes, we just use the shorthand, call it a partnership. Is that fair?
Yep.
Anything to add to that?
No.
Okay. Well, then hit us with thing number 3.
Third thing is K-1 reporting. So as we've sort of mentioned already, the partners and shareholders of partnerships and S corporations receive a Form K-1, and that reports to those members and shareholders all of the income that is passing through to them, income and deductions, possibly credits. So all of those items retain their character as they pass through to the individuals as they're reported on those individual income tax returns. Anything you want to add to that?
Let me see. No, I don't think so. Now, the issue of character retention is sometimes a new concept to folks, But what we mean by that is if, just use to keep saying both of them, say an S corporation has a capital gain, something that qualifies for capital gain treatment. Again, the S corp is generally not paying any income tax on that gain. That gain passes through to its owner or owners. That capital gain is, of course, eligible for a lower rate in a lot of cases.
Right.
So for it to be taxed that way once it gets to the owner, it has to be reported in the K-1 as a capital gain and not just in this just general bucket of income. So you got ordinary income, you got rental income, capital gains, other categories of income and losses, so that those items retain their character as they pass through the owner and get treated by the owner very much in the same way they would if that owner operated that business or her or his share of that business as a sole proprietorship.
Right.
Okay. So that's number 3. Number 4, self-employment tax. We could go down this rabbit trail for a while. We won't. Just know that there are differences here in treatment for self-employment tax. And self-employment tax is really nothing but both the employer and the employee share of payroll tax, all paid by the individual who owns a share in the entity. So pass-through income from a partnership may be subject to self-employment tax, and very often is. It's based on a number of factors. Interestingly, pass-through income from an S corporation, not subject to self-employment tax. So that is a potential advantage of an S corporation over a partnership. And again, partnership, LLC, anything treated by default as a partnership. And that actually brings up, I'm going to mention item 4A.
Okay.
You ready?
I'm ready.
Item 4A is an LLC is by default treated as a partnership, but it is possible to make an S election for that kind of entity and have it treated as an S corp. It's a whole other conversation. And actually, I think we do have an item. We'll come back to that later, but I wanted to mention that there was something else I interrupted you were about to share.
No, I thought you were going to come back. You were going to skip ahead and talk about reasonable salary.
Nope, we got to keep it at 10 items.
Okay.
So number 4, self-employment tax. Partnership income passing through may well make the owner liable to self-employment tax on it. S corp pass-through income doesn't.
Right.
However, that brings us to number 5.
Yes. So number 5, S corporations must pay their owners a reasonable salary. Now, the shareholder, isn't responsible for their share because their share of the payroll taxes are being paid by the corporation. However, that reasonable salary is a number, that you really do need to analyze and make sure that the shareholder is being paid a reasonable wage.
Right.
If it's too low, that's a red flag to the IRS.
Right, and measuring it relative to how much money is being taken out, being taken out of the corporation, not as salary but as distribution, is one good way to look at it. Because the bottom line is, you ask what's a reasonable salary, the honest answer is, I don't know. It depends on a lot of factors. It depends on the industry. It depends on how much money you're taking out in total. If you're paying yourself a salary of $5,000, but you're taking $100,000 out as a distribution every year, you're potentially at risk for having that conversation with the IRS and losing it.
Right.
In which case, it is important to note that you're paying income tax on all the pass-through income. You're not paying income tax on distribution. So really what you're at risk for there is potentially unpaid payroll taxes. Basically the reclassification of distributions as salary. Again, the pass-through income, you're already paying income tax on all of that anyway, but you are looking at potential exposure for payroll tax.
Right.
So we called that number 5, but we actually had it on the paper as number 6.
Yes.
So that means to get to number 6, we have to go back to what's printed on the page as number 5 and make it number 6. Is that clear?
But I think it fits right in.
It does. Clearly that was a printing error and those should have been reversed.
Because it is talking about guaranteed payments, which are payments to partners of a partnership.
Wait, so hold on a minute. So we were just talking about S corps and we were talking about paying a reasonable salary, which that's going to get reported the same way you'd pay anybody else's salary on a W-2.
Right.
So what you're going to tell me is the exact same thing happens with a guaranteed payment from a partnership. That
is in fact not correct.
That is incorrect. That was deliberate, by the way. I do in fact know that that is not correct. So what you're telling me is that partners, members, anybody treated as a partner for federal income tax purposes should not be issued a W-2 and shouldn't have income taxes and FICA, Medicare, et cetera, withheld on them.
Correct. They should also not be issued a 1099.
Right.
So those guaranteed payments paid to partners are reported directly on their Form K-1 as a guaranteed payment. That's one of those separately stated items that, the partnership issues on their K-1s.
Right. Really, the reason for that is for whatever reason, the tax law is such that someone treated as a partner in a partnership is liable for all of their own payroll taxes, again, self-employment tax. So if I am a partner in a partnership and I'm getting my allocable share of income, but I am also getting paid a salary, essentially of $100,000, that's not subject to withholding. It is, however, going to be subject to self-employment tax, and it doesn't go into 1099 either. It goes on the K-1 as a guaranteed payment. Again, it's a salary, it's deductible by the company, but it is taxable income to, of course, just that member receiving it, and it is subject to self-employment tax. And again, going back to our earlier number, other allocable income from that partnership may also be subject to self-employment income based on a number of factors.
Right.
Okay. So let's switch back over and talk about S Corps for a minute. So we've talked about some ways that they're the same, some ways that they're different. Another key difference, and this is a potential disadvantage, or at least some people see it this way for an S Corp, is an S Corp is pretty limited in how it can allocate income. It's actually very limited in how it can allocate income. S corporations have to meet very specific requirements about who can own the stock, how many classes of stock you can have in an S Corp, which happens to be one. That's a pretty easy number to get to. And how income can be allocated. It's basically a very strict per share, per day allocation. Anything that deviates from that, you're at risk of having what is effectively a second class of stock, which would bust your S election, is what we call it. So just know that compared to partnerships, which we're about to talk about, S Corps have some pretty rigid rules in terms of who can own the stock and how the income from it has to be allocated, which brings us to the next item.
But I'll also say one thing.
Yeah.
They're also limited on how they can make or split distributions.
That's exactly right. Yeah, I was talking about income allocation and didn't mention distributions. It's the same thing because, again, just like with income allocation, a disproportionate distribution looks like your stock's not the same as my stock, so you must have two classes of stock.
Right.
Right. Good point.
Yep.
All right. So if we're talking about S Corp limitations, that brings us to the next item. We're going to call it item 8, and that is the flexibility of partnerships.
Right.
They're very flexible.
They are very flexible.
Moving on.
For a lot of the reasons we just talked about S corporations not being flexible, with a partnership, you can make distributions to partners that are not pro rata.
Right. Well, depending.
You can, depending on your operating agreement.
Right.
You can make income allocations to partners that are not pro rata. Again, we're always looking at operating agreements for partnerships to be sure that income and distributions are being allocated based on what those partners agreed to when they signed up for that partnership.
There's a very complex, this is probably the most complex thing that we're going to talk about this morning. There's a very complex interplay between the ownership agreement for a partnership and the tax law, and really specifically IRS regulations. Basically, what the law and the regulations say is that, hey, what your agreement says is what goes, unless your agreement does not comply with certain concepts and standards in the tax regs, things like things such as substantial economic effect. I won't get into that here because that's like a week-long conversation, at least a good solid day and a half. But what makes partnerships arguably one of the most complex concepts in the tax law is the amazing flexibility that you do have with them. And that flexibility can make things complex. It can also cause problems if you aren't really aware of how I call it the plumbing of your partnership is built. We've seen folks that have agreements that really dictate things that they didn't intend, and we've seen agreements that maybe dictate things that aren't going to be in compliance with the tax law. So it's very complex, but you can do a number of things with a partnership structure, again, LLC, PLLC, et cetera, that you can't do with an S corp. All right, so quickly wrapping up, we got 2 more items, including the last item, which is the big one. We said you got to hang around. It's brand new. Got to hang around for it. So I mentioned this briefly earlier, but just know that there are a number of entities that could be treated as a partnership, or as an S corp, or as a C corporation. There's a set of rules in place that allows for certain entities meeting certain requirements to basically choose how they want to be treated, right? So if you're a partnership, I think an S corp would work better for me. There is the possibility of getting into an S corp structure without actually legally changing your entity. Sometimes that is required, but not always. Or the other way, or to be a C corp. We're not even talking about C corps this morning,
right?
Because we wanted to focus on folks who are getting their K1s and folks who are working on getting K1s done. But C corp is a possibility as well.
Yeah.
Anything else on entity classification?
We won't go into the details, but there are some specific due dates on making those changes.
That's right.
So that's something to be mindful of.
That's right. Yeah. You can do things sort of during an operating year, but if you want to get an entity change effective at a year end, you do have to comply with certain due dates. And fun fact, you could, at least as of the recording of this, and maybe for a few more days, you could actually make an entity classification election to change your entity type if you meet all the requirements, basically retroactively to the end of 21, beginning of 22. So it's not too late if that's something that you're interested in. Again, everybody's facts are different, but just in terms of the timeline, there is still time to do that.
Right.
Okay. We're interrupting the regular video to give you an update. Now, at the time we recorded the original video that you've just been watching, our number 10 had to do with K2 and K3 reporting, which was what? And still is what?
Our big news.
What was our big news? Yeah, it was our big, but what is it actually? So K2 and K3 are meant for what?
Reporting foreign income, well, the split of foreign or domestic income and expenses.
Right. Guidance had been issued by the IRS very recently that was going to require an awful lot of domestic partnerships and S corps that had no foreign income, no foreign activity to file those forms. That was our big number 10. So now our big number 10 is that at the time of this recording, the IRS is saying they're going to provide relief so that those domestic partnerships and S corps won't have to file those forms for 2021 if they don't have that activity. Whereas before, if you had a partner or a shareholder directly or indirectly who did have foreign activity from some other source, that partnership or S corp would have to file those forms. So the IRS has just now said, again at the time of this recording, they're going to provide relief for that, so those entities won't have to file them for 2021, right?
Right.
And that's a big deal. Such a big deal that we interrupted the flow of the regular video to give you a new, improved, hot, fresh, number 10 thing to know about pass-throughs.
Yes, breaking news straight to you.
Breaking news straight to you. So now we're going to try to artfully edit the video back to our original ending, which I think should remain unchanged. Okay, so it's now time for a blink and you'll miss it edit back to the regular video. Okay, so that was big number 10 we wanted everyone to hang around for.
Right.
As usual, we've probably gone on for way longer than we intended.
Yeah, it's all good information.
Yeah, but thank you all who have hung out with us for the entire video. Anything else that we need to pass along? There may not be.
Not that I can think of.
Okay.
You?
Can't think of a thing. So I guess we'll sign off. You want to take us out?
Thanks for joining us today. Look for more videos from us, and you can follow us on social media.
Right.
We're on Facebook, LinkedIn, Instagram, and Twitter.
Occasionally.
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 So follow us. You can view all of our videos on YouTube.
Right.
And we will see you soon.
Thanks a lot.